Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial statements of major corporations and sometimes companies that are making some pretty interesting moves in the biotech world. Today we're diving into Ginkgo Bioworks Holdings Inc. and their latest quarterly report, which is packed with details about their operations in the first half of 2000, our operations in the first half of 2025. Get ready for some deep dives into their revenue, expenses, and where all their money is going. First off, let's just acknowledge the elephant in the room. The company has undergone a 1-for-40 reverse stock split on August 19, 2024, which means all the share numbers from before that date have been adjusted to make the comparison clearer. As of June 30, 2020, 2020, 2020, 2020, 2020, 2020, 2025, Ginkgo had over 43 million Class A shares of common stock outstanding. Now let's get into the numbers. Ginkgo reports revenue from two main areas, cell engineering and biosecurity. In the second quarter of 2025, cell engineering brought in $39.1 million, up from $36.2 million in the same quarter last year. That's a nice bump up driven by programs with big customers in pharma, biotech, and the US government. But hold on a second, the 6-month numbers tell a slightly different story. For the first half of 2025, cell engineering revenue was $77.4 million. Up from 36-month numbers tell a slightly different story. For the first half of 2025, cell engineering revenue was $77.4 million, up from $64.11 million from $64.11 million the previous year. This increase, though, was helped significantly by a one-time recognition of $7.5 million in deferred revenue from a terminated contract. With Biomeda Inc., quote, ones with big customers in pharma, biotech, and the US government. But on the biosecurity side of things, revenue took a hit. For the second quarter of 2025, they reported $10.5 million in the second quarter, of 20 significant drop. This was mostly due to lower revenue from a government program. The first half of 2025 also saw a decline, with biosecurity revenue at $20 million compared to $30.1 million in the first half of 2025. Also saw a decline with biosecurity revenue at $20.6 million compared to $30.1 million in the first half of 2025. Also saw a decline with biosecurity revenue at $20.6 million compared to $30.1 million in the first half of 2024. This downward trend in biosecurity is definitely something to watch if this segment is meant to be a growth driver or a stable counterpoint to cell engineering. But where is all the money going? Well, a huge chunk is going into research and development. For the first half of 2025, R&D expenses were 125, R&D expenses were 124. This reduction is largely thanks to their restructuring plan, which involved cutting personnel and optimizing operations. The company expects these R&D costs to stay steady or even decrease this year, which makes sense given the ongoing restructuring efforts. They're refocusing on their core foundry and code-based assets and their new tools offerings. General and administrative or G&A expenses also saw a notable decrease, falling to $92.3 million in the first half of 2025 from $136.6 million in the same period last year. This again is a direct result of the restructuring and efforts to cut operational overhead. However, an increase in rent and facility expenses is a bit of a red flag, especially since a new leased space remains unoccupied. In a significant move during the second quarter of 2024, the company had to fully write down its goodwill balance of $47.9 million related to its cell engineering segment. This indicates that the value of that part of the business didn't live up to expectations when compared to its carrying value on the books. And speaking of restructuring, the company incurred $8.9 million in restructuring charges in the first half of 2025, down from $17.1 million in the first half of 2024. These charges are mainly for employee termination costs from the workforce reduction that started in June 2024. Looking at the cash flow statement for the first half of 2025, Ginkgo used $91.8 million in cash for operations. This is better than the $73.6 million they used in the same period last year. The improvement is partly due to lower R&D and G&A expenses, but it's still a substantial outflow, suggesting the company is still investing heavily in its future. On the investing front, the company spent $262.6 million in the first half of 2025, mostly on purchasing marketable debt securities, which helped them build up a considerable investment portfolio. This is a shift from the previous year when most of the investing cash went into property and equipment and business acquisitions like Cymagen. It seems they are now focusing on managing their cash and putting excess into more liquid investments. Interestingly, their cash and cash equivalent situation has changed quite a bit. As of June 2025, they had $203.6 million in cash and cash equivalents, a significant drop from $561.6 million at the end of 2024. This decrease is largely due to those investments in marketable securities we just talked about. They've essentially shifted a good portion of their readily available cash into these investments. Their total investments in marketable securities as of June 2025 stood at $277 in US Treasury securities. And corporate bonds, it's clear they are actively managing their treasury operations and looking for ways to make their cash work for them, while also maintaining liquidity. Short-term debt securities like commercial paper and US Treasury securities are considered highly liquid and a way to park cash safely. Now let's talk about their notes receivable. As of June 30, 2025, the company's notes receivable had an unpaid principal balance of $22 million, but a fair value of only $7.5 million. This is a pretty steep discount and indicates that a significant portion of these debts either carry a high risk or are unlikely to be fully repaid. The company uses a discounted cash flow model with unobservable inputs for these valuations, meaning a lot of assumptions go into determining their worth. Contingent consideration, which relates to payment obligations tied to future milestones from past acquisitions, also shows some interesting numbers. As of June 2025, the total contingent consideration liability was $5.7 million. It's worth noting that in previous periods, especially in 2024, a considerable amount of these liabilities were settled through stock issuances or cash payments. The fair value of these liabilities is estimated using unobservable inputs like probability of payment and discount rates, meaning there's a lot of estimation involved here and actual outcomes could differ significantly. One area where expenses have remained substantial is stock-based compensation. In the first half of 2025, Ginkgo recorded $42.7 million in stock-based compensation expenses compared to $77.9 million in the same period of 2024. While this is a reduction, it still represents a significant cost. A large portion of this expense is in the R&D and G&A departments. The company recently made a modification to founder options which resulted in an additional $10.5 million in incremental compensation expense, and compensation will be recognized over the remaining service period of those awards. So what does all this mean for Ginkgo Bioworks? On the positive side, the company is clearly working to streamline its operations and reduce costs, as evidenced by the significant drops in R&D and G&A expenses. Their focus on the cell engineering platform and the expansion into tools and data generation products like data points shows a strategic pivot. The increased revenue in cell engineering, despite the one-off boost from the biomedic contract, hints at some underlying growth. However, the declining biosecurity revenue is a concern, and the substantial use of cash in operations highlights the capital-intensive nature of their business. The large discount on their notes receivable and the complexity of valuing contingent consideration also point to potential financial risks. A key opportunity for Ginkgo seems to be leveraging their extensive codebase and foundry capabilities to drive innovation and attract more customers, particularly in high-growth sectors like pharma and biotech. On the risk side, competition within the synthetic biology space remains fierce, and external factors like market conditions and technological advancements could impact their ability to stay ahead. The company also has a significant contractual commitment with Google Cloud that needs careful management. Scroll clear conclusion. Ginkgo Bioworks is undergoing a significant transformation marked by cost-cutting efforts and a strategic shift in its service offerings. While there are signs of progress, particularly in cell engineering, the company faces challenges with its biosecurity segment and managing its cash burn. Investors will be watching closely to see if these restructuring measures translate into sustainable profitability looking forward. Alright, that's our breakdown of Ginkgo Bioworks' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.